A virus breaks out on a ship. People die. Headlines go global. Biotech stocks spike. And the market barely moves. 4 years ago, a different virus broke out, and markets lost 34% in 33 days. Same fear, completely different result. Today, I'm going to explain exactly why, Chane, and what the difference teaches you about every future outbreak. Let me take you back to February 2020. The S&P 500 was at an all-time high of 3,386. Then COVID hit Western markets. In exactly 33 days, the fastest bear market in recorded history. The S&P 500 lost 34% of its value. $11 trillion in market value evaporated. Airlines lost 80%. Hotels lost 70%. Oil went negative for the first time in history. But not everything fell equally. Airlines lost 82%. Cruise lines 80%. Hotels 70%. Oil went so low that futures briefly traded at negative $37. Meanwhile, technology stocks only fell 27% and recovered within weeks. Healthcare gained. Zoom went from $8 to over $500. The crash was devastating, but inside it was a massive rotation, not a uniform collapse. Here is the framework every investor needs to understand before reacting to any outbreak headline. 3 things must happen simultaneously for a virus to become a market event. First, human-to-human transmission that can shut down economic activity. Second, government lockdown responses that actually close businesses, borders, and supply chains. Third, uncertainty so extreme that the Federal Reserve needs to act. COVID had all 3, that is why it crashed markets. Most outbreaks have none of the 3. Here is the single most important fact about the COVID crash that most retail investors never learned. The market bottomed on March 23, 2020, the exact day the Federal Reserve announced unlimited quantitative easing, not a vaccine, not a treatment. The Fed buying unlimited bonds. The market did not recover because the virus was controlled. It recovered because the Fed removed the fear of financial system collapse. Understanding this changes how you read every future crisis. Who made money during COVID's market crash? Bill Ackman bought crash protection, turning $27 million into $2.6 billion in a matter of weeks. Cathie Wood bought beaten-down tech stocks at the bottom of the crash, and her ARK fund gained over 150% in the following year. Retail investors who simply bought the S&P 500 on March 23rd, the exact bottom, doubled their money by 2021. Warren Buffett sold airlines and admitted he made a mistake. The lesson? Knowing the framework matters more than panicking. Let me show you the full historical picture. SARS in 2003, S&P fell 12% and fully recovered in 3 months. MERS in 2015 barely moved markets at all. Ebola in 2014, a 7% dip that recovered within weeks. Swine flu in 2009, markets fell 27%, but that was the financial crisis, not the flu. And COVID, 34% in 33 days. The pattern is clear. Most outbreaks are market noise. Only one in modern history was a genuine market event. What made COVID genuinely different from every outbreak before it? 4 factors aligned simultaneously that had never happened before in modern market history. COVID spread before people showed symptoms, meaning it was impossible to contain without shutting everything down. 22 million American jobs vanished in 2 weeks. Global manufacturing halted simultaneously across every continent. And governments had no choice but to respond with $5 trillion in stimulus, which created the inflation we are still dealing with today. Now let us apply the framework to Hantavirus. The MV Hondius cruise ship. 3 deaths. A U.S. citizen testing positive. The WHO issuing an alert. Alarming headlines. But run it through the framework. Hantavirus spreads primarily through contact with infected rodents, not person to person. The WHO explicitly rates the public health risk as low. Gear 1 of the framework, economic shutdown risk, does not engage. Without Gear 1, Gears 2 and 3 cannot follow. Here is the complete comparison in one table. Every single factor that made COVID a market event, human-to-human transmission, economic shutdown risk, global supply chain disruption. Hantavirus has none of them. COVID engaged all three gears of the outbreak framework simultaneously. Hantavirus engages zero. That is why COVID crashed markets 34%, and Hantavirus moved Moderna 2.7% on a fear trade before fading back. Moderna spiked 9% the moment Hantavirus headlines hit. By the close, it was up just 2.7. This is the anatomy of a fear trade. Algorithms read the headline. They buy anything connected to the word outbreak. Then analysts, who actually read the science, push back. The Evercore analyst covering Moderna explicitly stated there is no near-term revenue from Hantavirus. The market corrected within hours. The investors who bought the spike on fear sold at a loss. The ones who understood the framework never bought it at all. This pattern repeats every single time an outbreak makes headlines. Ebola in 2014. Biotech stocks spiked, then faded within days. Monkeypox in 2022. Vaccine stocks surged, then gave it all back within weeks. Hantavirus in 2026. Moderna up 9, then back to 2.7 in hours. Knowing this pattern is worth money. It tells you exactly when not to chase a spike. The real outbreak investors should be watching in 2026 is not Hantavirus. It is the Iran war. COVID worked by shutting down physical movement of people. The Iran war is shutting down physical movement of energy, 20% of the world's oil supply, through the Strait of Hormuz. COVID created inflation by collapsing supply chains. The Iran war is creating inflation by collapsing energy supply. COVID forced the Fed to act with emergency cuts. The Iran war has frozen the Fed from cutting at all. Different cause, identical economic damage mechanism. Economists call what COVID created a supply shock, a sudden disruption to the supply of goods and services that causes prices to spike and growth to fall simultaneously. The Iran war is creating an energy supply shock through exactly the same mechanism. Both events share the same economic fingerprint, and both events create the same market dynamic. Sector rotation away from rate-sensitive growth stocks toward energy, defense, and defensive plays. Here's the COVID recovery playbook and how it maps to right now. Phase 1 was panic. Sell everything, raise cash, rotate to defensives. Phase 2 began the moment the Fed intervened. Buy beaten-down quality growth stocks aggressively. Phase 3 was the full recovery. Growth leads, energy fades, rates eventually fall. Right now, with the Iran war ongoing and the Fed frozen, we are sitting somewhere between Phase 1 and Phase 2. What ended the COVID crash and triggered Phase 2? The Fed removing the fear of financial collapse with unlimited bond buying on March 23rd. For the Iran war situation, there are two equivalent triggers. Either a Hormuz deal is reached, oil drops below 90, inflation eases, the Fed gains room to cut, growth stocks rally hard, or the Fed signals rate cuts despite sticky inflation. Both paths lead to the same Phase 2 outcome. The only question is timing. COVID created clear sector winners: technology, healthcare, e-commerce, home improvement. The Iran war is creating its own clear sector winners: energy companies benefiting from high oil, defense contractors, and AI infrastructure companies whose supply-constrained demand makes them resilient to macro pressure. The mechanism is different. The principle is identical. Every supply shock creates losers in the disrupted sector and winners in the adjacent sectors. Here is the 5-question checklist every investor should run before reacting to any outbreak headline. Question 1. Does it spread person to person easily? If no, stop right there. It is not a market event. Question 2. Can governments respond without shutting economies? If yes, not a market event. Question 3. Is it geographically contained? If yes, not a market event. Question 4. Has the Fed already responded? If yes, you missed the bottom. Question 5. Are sector rotations forming? This is where the real opportunity sits. Run Hantavirus through the checklist. Question 1. Does it spread person to person easily? No. Stop right there. That single answer tells you everything. Hantavirus is not a market event. Moderna's 9% spike was the wrong trade for anyone who understood the framework. The checklist takes 30 seconds. It saves you from chasing spikes that reverse in hours. Look at these three charts: SARS, 2003, Ebola, 2014, monkeypox, 2022. Every outbreak that did not engage the three-gear framework produced the exact same pattern: a sharp fear spike, followed by a complete reversal to pre-outbreak levels within 3 to 6 months. The shape is identical across 20 years. Hantavirus will follow this same pattern. History does not repeat exactly, but in markets, it rhymes with extraordinary precision. Here is the real lesson. Most outbreaks are fear trades, not fundamental market events. The three-gear framework tells you within hours whether you are looking at a real risk or a spike to fade. And every genuine supply shock creates sector rotations that reward investors who understand the mechanism and punish investors who panic. The opportunity is never in the panic itself. It is always in the rotation that follows. Your outbreak playbook in 3 cards. Card 1. Every time you see an outbreak headline, run the 5-question checklist before you touch your portfolio. Card 2. If the checklist says it is not a market event, ignore the biotech spike completely. Do not chase it. It will fade. Card 3. If the checklist says it is a genuine market event, rotate to defensives immediately and then watch for the Fed trigger that signals it is time to buy quality growth at the bottom. Drop a comment. Which supply shock worries you most for markets in 2026? The Iran war energy shock, a new COVID-level pandemic, or an AI infrastructure bottleneck from chip shortages? I read every comment. I am Marcus. If this framework helped you think about outbreaks and markets differently, subscribe and hit the bell. NVIDIA reports May 20th. The Trump-Xi summit results are coming in. The Iran situation is still moving. I will see you in the next one.